Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Verdict 2019 has been delivered and it is time for Modi 2.0. The stock market has been in a euphoric mood, but there are several uncertainties ahead as well. It's perhaps a very good time, therefore, to take stock of your portfolio with this year, once in a 5-year political event finally behind us. So, does one need to tweak the asset allocation mix right now? Is there a need to change the kind of funds that you've invested in? These are some of the issues and some of the questions that we will discuss on the show today. I have with me Ashish Shankar of Motilal Oswal Private Wealth, as well as Abhijit Bhave, CEO of Karvy Private Wealth. Welcome to the show, gentlemen.
Thank you so much.
Thank you for joining in. So it has been up, away since not actually even the 23rd, 24th, even prior to that, just when the exit polls came out. But now that this big event is over, I think it's a good time to take a reality check and see if something needs to be done. So your first thoughts, Ashish?
Yeah, so first of all, pleasure to be on your show, and I'm glad we're doing it live this time. So look, there's a big sense of relief that the event is past us. There was a lot of anxiety as to whether we'll get a stable government, we'll get a coalition, but I think that is behind us. So going forward, the focus will be more on fundamentals now. I strongly believe that whatever hypothesis we had before the elections, our hypothesis was that you will see a broader earnings recovery by the end of this year, and that hypothesis still stands true. Yes, in the large cap space, let's say Nifty, the valuations are definitely not cheap, they're expensive. So going forward, the return expectation has to be a little muted. So I think the best strategy for HNIs is to take stock of their portfolio right now, at least on the equity side, and see whether they're adequately invested. If they're adequately invested, my advice to them is stay invested, because we are positive on earnings. But if they're not adequately invested, then gradually get invested over the next few months.
It's interesting that you talk about tempering down expectations, return expectations, and perhaps looking at slightly muted returns, because that is not what one has heard in the last 3-4 days. I've been reading report after report, and a lot of market commentary about how things will turn around, the investment cycle will pick up, and this is perhaps the start of a great period. I don't know, are you a believer in this whole thesis with respect to the equity market, Mr. Bhave?
So when we were in school, we were taught A for apple. And in the last 6 weeks, we have been thinking E for elections, E for elections. We forgot the other word starting with E. So Ashish said E for economy, E for earnings. And with Modi 2.0, there's a lot of expectations, a lot of growth in the economy, a lot of growth in the earnings, and I think good days are here again. I would not go with muted expectations. I believe that the next 5 to 7 years, possibly maybe the best years of the equity market in my life.
Okay.
I've been working in the markets for the last 24 years and I'm very positive, and that's why we have been equity overweight right before November. I remember when we had met in December, we had said that go overweight equity, and we still remain overweight equity.
Okay, so we have a big bull in the house, and we have maybe a cautious, cautiously optimistic bull in the house as well. Fair enough, but this is all about sort of individual allocation. Now, what happened just prior to this was that there was a lot of advice given on how perhaps most portfolios need to be more large cap oriented.
Right.
Mid caps have not been doing very well, a lot of talk of risk aversion, earnings not picking up, slowdown blues, etc. Right. So my first thing is, first question is that for any medium risk appetite portfolio, is this a time to change the balance between mid caps, small caps, and maybe add a bit of the latter?
Yeah, so the straight answer to that is yes, definitely. And let me take you back a little bit in history. So if you look at the year 2017, it was a fantastic year for equities, right? You had the small caps going up 55%. You had large caps going up 28%. So there was a 27% divergence on the upside in terms of returns. Now you fast forward from December 31st, 2017 to date. What has basically happened is that your Nifty corrected 15%, which is large caps, and has come back to all-time highs. Small caps fell 35%, mid caps fell 23-24%, and they're hardly about 5 to 10% above their all-time lows. So there is a divergence on the other side of 27%. So from a valuation perspective, the broader markets or mid and small caps definitely do look more attractive than their large cap peers. So just to go back to the first opening statement that I made, when I said my expectations are muted going forward, they are more so on the larger companies.
Okay.
I think the larger companies going forward, you can easily model in a 12 to 13% kind of a return expectation going forward, given where valuations are. But the broader market can give you much higher returns. And we do expect that to happen with earnings recovery on the annual. So that's what we believe, that this is definitely time to change gears and probably look at allocating more money to mid and small cap funds within the portfolio if you're not adequately allocated to that segment.
Okay, that's an interesting point. I'm going to come back and talk to you about the funds in that case. But first, Mr. Bhave, do you concur? Is this really the time for mid caps now?
This time I agree with Ashish.
Okay.
So we have also in our model portfolio added something on the mid cap. So if you look at the overall portfolio, we are saying that we should have around 45% of your portfolio on the equity side in large caps, 20% in multi cap, 25% in mid caps, and 10% in sectoral. And the two preferred sectors for us are infra and banking and financial services.
Okay, fair enough. So we have agreement that largely speaking the market's heading higher. Our experts feel this is a good time to be looking at mid caps and small caps. Before we start talking funds, just one more question. Thematic funds, specifically infra funds, because once again the whole expectation is that there's going to be this massive infra spending, big push will come through. So economy facing stocks, cyclical stocks, these might start doing better. We do have some infrastructure funds in the market. They have had abysmal returns in the last couple of years. Right. Should one even consider them, Ashish?
So, I think a lot of times investors loosely correlate government spending on infrastructure and profitable growth for companies. See, in the long run, what makes you returns is profitable growth. So government spending on infrastructure, a lot of companies trying to capture that spend and then creating profits out of it. It's a big stretch. So according to us, or I'm not a big fan of thematic funds, because let's say you may have a lot of spending in infrastructure, but like we saw last time, a lot of this growth may not be profitable. So then stock prices eventually don't go up. So I still believe that if you stick to larger mandate funds like multi-cap funds, or even in the mid and small cap diversified funds, you have a lot of infra exposure. It's a better way to participate rather than trying to go into thematic funds, because we know a lot of clients who burned their hands in thematic funds, whether you say pharma, infra, I mean in the heydays of .com.
You're looking at one person here. I remember 2008. I remember investing in one infrastructure fund. Let's not talk about what happened there.
Right.
But I take your caution, therefore I understand where it's coming from. But Mr. Bhave, I mean, for someone who has that appetite, risk appetite, I mean, should you really go out and sign the check on an infra fund today?
So this all lies in allocation. How much are you doing? So we are saying that don't allocate beyond 10% to a thematic fund. And on the infra side, the NDA 2.0 would stand for the infra growth story, whether it is roads or ports or airports or waterways, everything would typically be expanding. So we are saying that look at a true blue infra play, and our preferred fund scheme is IDFC Infra Fund, where it is excluding all those quasi infra themes like banking. It looks at true blue infra. And if you look at, sorry,
no, that's a very important point you're raising, because the other day I checked up one particular, AMC's infra fund. It was loaded with NBFCs and banks. How is it a pure play infra fund then? But then more about this fund.
So if you look at the NDA plan for the next 5 years, they're looking at spending around $1.4 trillion on infra, and that would mean increase in sales for so many companies, and that would mean large companies, small companies. And if you look at a large cap or a multi-cap fund, it will not be able to take advantage of that. So we are saying that though we'll have multi-cap funds and large cap funds buying infra, there is some potential for having an infra fund in portfolios for people who are aggressive kind of customers.
And you're recommending the IDFC infra fund in that context. All right, let's do one thing. Let's take a very quick break. We're just warming up, because on the other side is the real meat of this conversation. The top 5 funds for the next 5 years, assuming that this market is heading higher with the policy reforms being on their way. We will talk about that, plus the all-important discussion on other asset classes beyond equity. How should your portfolio look during Modi 2.0? We'll be back after the break. Welcome back. You're watching Money, 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 and this is the Verdict 2019 special. Yes, we are discussing how you should evaluate your portfolio now that this big election event is well and truly behind us. So now let's boil it down to the most interesting part, gentlemen. That is the funds for the next at least 3 to 5 years. What does your list look like, Ashish?
Yeah, so within the multi-cap space, I have 3 funds. The HDFC Equity Fund, the Motilal Oswal Multi-Cap 35, and the Invesco Contra. I think these 3 funds are aptly positioned for the next 4-5 years. Like I said, I am also bullish on mid and small caps. So within the mid and small cap space, I like the Franklin Primer, and I also like the Kotak Emerging Equity as well as HDFC Small Cap. So these are 6-7 fund recommendations, and your clients can build a portfolio with these funds.
Okay, just to quickly go over some of the ones that you're talking about, let's talk about the multi-caps. And I understand that you mentioned because there will be the ease of maneuverability.
Absolutely.
The fund manager can decide sort of how the allocation should be.
Right.
So HDFC Equity, the ICICI India opportunities, what are the key features that you like about these funds?
So I think Prashant Jain is always ahead of the curve. He's been invested to benefit from the investment cycle. So if you look at some of his core holdings, he's got position in corporate banks, which will be the biggest beneficiaries as and when the credit growth comes back. Then he's got plays in the infra space as well as in the utility space. Now these are sectors that have gone through a rough time over the last 5-6 years, where a lot of cleanup has happened and consolidation has happened. So now when growth comes back, these companies will capture a large part of this growth. And you can already see over the last 3 years, the fund has done a lot of catching up in terms of returns. In fact, it's in the top quartile over the last 3 years. So I like the positioning of HDFC Equity, the portfolio. The second fund, again, you mentioned was ICICI India Opportunities portfolio. Again, similarly positioned. It's trying to invest in sectors which are linked to the investment part of the economy. Of course, there will be some consumption stocks as well. Now, this is a portfolio again managed by a veteran fund manager, Naren, who's been through various cycles, and he is known to be a contrarian stock picker. So the positioning is in companies that are likely to benefit from the next cycle of growth.
Okay.
The other fund, which is got a now 5-year track record, which is Motilal Multi-Cap 35. This has got a combination of good quality companies which are likely to benefit from the growth. So you've got private banks, you've got some auto stocks, and you've also got some participation in the infra sector through L&T. And this is again a portfolio which has a very high ROE, very high quality, has completed a successful 5-year track record. The near term performance is a little weak, but that's where the opportunity lies.
Okay.
So these 3 can be core holdings
in the multi-cap,
in any portfolio in the multi-cap space.
Okay, so quick reminder there, the 3 multi-cap picks from Ashish's side would be HDFC Equity, ICICI India Opportunities, and the Motilal Oswal Multi-Cap 35. I'll come back to the remaining funds that you picked out for us. But since we're talking multi-caps, Mr. Bhave, your choices here?
So the question you asked was top 5 for the next 5. So there was a very old ad of a motorcycle which said, just fill it, shut it, forget it. So trying to look at funds which are going to be having a consistent track record and will normally give peace of mind to people. So what we have picked up is we have picked up 2 multi-cap funds. One is the Kotak Standard Multi-Cap Fund, which does bottom-up stock picking and which has been doing well across market cycles. The other one is the UTI Equity Fund, which is a low beta kind of portfolio, which even in volatile markets has done well. So these 2 should be the core holdings, having 50% of that in the portfolio that you have. One forward-looking pick that we have done is Mirai Focused Equity Fund. Now this is a new category called Multi-Cap Focused, which has at max 30 stocks. And in the past, Mirai as a fund house has done very well across equity funds, and these are the top 30 picks. And this has just come out as a NFO earlier, now it's going to reopen. So we believe this fund would be a fund for the future, and that's why we have picked up this fund.
Okay, so those are 3 multi-cap picks from both our experts. Let's go back to some other funds. Beyond multi-cap, the 4th fund that you would put in the portfolio.
Yeah, so I'll recommend 3 more funds in the mid and small cap space. The Franklin Primer, which is again a evergreen fund. It's a bottom-up portfolio of a lot of companies in the mid-cap space. The second fund is Kotak Emerging Equity. Now, this fund again is focused in the mid and small cap space, has got a lot of exposure to industrials and manufacturing, will benefit from the investment cycle coming back. And the last one is HDFC Small Cap. Very well managed fund, excellent track record. Again, Chirag, who's the fund manager, has a long history of managing successful funds, a little bit of a contrarian, so you'll get a portfolio that is not very expensive. So within the mid and small cap space, these are the three funds that we like. And like I said, clients can increase their allocations to these type of funds at the current juncture.
So this is really interesting. You've got a whole bouquet which has 3 multi-cap funds, and then there are 3 other funds which are all in the mid and small cap category. Perhaps it's a sign of the times that we live in. We've done 3 multi-cap funds with you as well, Mr. Bhave. So some more additions to your list?
So we actually have picked up only one mid-cap fund.
Okay.
Because we already have certain mid-cap allocation given in the multi-cap funds. So our top pick is HDFC mid-cap fund.
Okay.
And this fund is quite well diversified. It works on the GARP strategy, growth at reasonable price. It has got around 60 stocks.
Okay.
And to my mind, if you just buy one fund and really have the conviction on that, and you obviously have the fund house and the fund manager with a very long stellar record, that should be good enough in terms of allocation on the mid-cap side.
Okay, so that becomes your 4th fund, and the 5th fund, as we've discussed, is the IDFC infrastructure fund.
So in fact, we have picked up 2 sectors, infra and banking and financial services. The 5th fund can be a combination or one of these 2. So either IDFC infra or ICICI banking and financial services fund.
Okay, there you go. So you've added a thematic fund for good measure as well in the bouquet.
Yes.
So that's how the recommendations stack up from Karvy Wealth as well as from Motilal Oswal Private Wealth. You mentioned banking and financial services, and that's going to bring me to the tricky issue right now. This entire talk of what's happening in the fixed income market, how NBFCs are hurting, and whether there will be some kind of a credit event, etc. Is it a good time then to still be in a banking and financial services fund?
Both me and Ashish work for NBFCs. But you're right. So
and you're both smiling, looking perfectly happy. So yes, that's very reassuring.
But see, just like there are good banks and bad banks, there are good NBFCs and bad NBFCs, and there are NBFCs which had issues on corporate governance. There are NBFCs which had issues in terms of borrowing in the short term and lending in the long term. So those are obviously avoidable. There are NBFCs which have got very good parentage. There are NBFCs which, for example, there are microfinance companies which actually borrow in the short term and lend in the long term. Is the reverse cycle. And there are housing finance companies, and there are other companies. So NBFC as a sector is not something we are saying is untouchable. And if you look at the banking fund that we have spoken about, they actually have a lot of large banks and some NBFCs having the big boy parentage. So I believe that this will have a superior return in the next 5 years.
Okay, so which are the specific banking funds where we don't have too much of exposure to slightly tricky or risky NBFCs, where one can still have a thematic
ICICI Prudential Banking Fund and SBI Banking Fund.
Okay, so you like the ICICI and the SBI banking funds. Your thoughts on this subject, Ashish?
So I believe the back of the structural bull run in NBFCs is broken. I think that going forward they will face structural headwinds as well as regulatory headwinds. So there will be a migration towards quality. So some of the high quality NBFCs will stand out. But according to me, next 5 years is advantage banks, because a lot of the banks have cleaned up some of their balance sheet problems. Deposit gathering is much easier for banks, and as the credit cycle picks up, banks are in the prime position to take advantage of that. So my view is that banks are a better bet to participate in the financialization story over the next 4-5 years. And a lot of these multi-cap funds already have about 30-35% exposure to the banking and NBFC sector.
Okay, so therefore you're not recommending something specifically.
Absolutely.
Got it. Now that we are talking banking, we've kind of had a pretty in-depth equity chat. What is going to be the advice in terms of asset allocation and fixed income this year? If the view is that generally speaking the equity markets are going to be taking off over the next 2 to 3 years, I mean, how should you look at fixed income? Because that market still seems to be in under a bit of a cloud, if I could say.
Right. So again, in fixed income over the last 6 to 9 months, especially after the ILFS episode, market has become very discerning in terms of credit. So, earlier we used to talk about a yield curve, which is basically we used to say that AAA borrowers can borrow at 8%, AA borrowers can borrow at 9%. Today, the concept of yield curve does not exist, because I can show you a AA which can borrow at 9, and there'll be a AA which won't get credit at even 11 or 12.
Correct.
So there is a liquidity challenge which needs to be addressed. That's a larger issue. But for your viewers, I still believe that it's best to look at high quality AAA bond funds today from a fixed income point of view, and wait it out a little bit till this entire episode gets fixed. Honestly, the AA funds as well as AA bonds are looking very attractive today in terms of yield. If you invest in a AA fund, I think you can end up getting a yield of close to 9.5. But frankly, we still don't know how this entire mess will get resolved.
You know, absolutely, that's the point, because the last 6 months, I mean, for the first time in I don't know how many years, was a period where people actually lost out on principal as well, where fund houses said, you know what, we can't pay you right now, either you roll over, you wait till we get payment back from, you know, people who've borrowed from us. So therefore, now if someone is still willing to move their money from a fixed deposit to a debt fund, I think there'll be a lot of question marks now for the retail category anyway. But if a retail investor wants to do that, which fund should he or she go to?
So actually, a person would come to debt because he is looking at capital preservation, and as you rightly said, that if he or she wants to get a higher return, he has to go beyond a fixed deposit. But this is not the time. Exactly what I told on this show in December, this is not the time for a normal investor to go into credit opportunity funds or even duration fund, because they don't understand the risks involved in that. So we are recommending, for a normal portfolio, you should actually go into secondary market bonds.
Okay.
And these are perpetual bonds of really good companies. You buy and you hold. For people who are looking at primary investment, they can actually look at high quality NCDs.
Okay.
If somebody really wants to go into mutual fund, as Ashish said, go only into AAA kind of funds and possibly into short term debt funds.
Okay.
Nothing beyond that. When we're talking of HNIs and we're looking at higher yields, and they understand that there is certain up and down swing that is going to happen,
sure,
then you go for a duration fund, because interest rates are going to get cut and all that stuff.
But that's for the HNI, slightly more sophisticated investor.
Yes.
Absolutely.
Yes.
I take your point. So that's a quick word on fixed income. As we are winding down the conversation, just an overall advice on the way the portfolio should be. This is, again, we're talking a medium risk portfolio. Ashish, people will also start getting excited perhaps about real estate. Right. Because it's an asset class that's underperformed for so many years now.
Absolutely.
There will be talk about affordable housing, etc. So, I mean, if you are sitting on lump sum money, or if you're likely to get, let's say, 50
right,
lakhs, etc., is there any merit in thinking real estate, or just stick to equity?
So, real estate, again, as an asset class, has faced multiple headwinds, including regulatory as well as funding challenges. My view is that real estate, at least in the next few years, will be more of a consumption asset class rather than an investment asset class.
Okay.
So my advice to viewers is that if you want to buy your own house, today is a good time to start looking and negotiating. You can get extremely good deals if you put out a check. However, as an investor, I'll stay away from real estate, because there is a lot of challenges in the sector which still need to be resolved. And I don't see prices going anywhere for quite a while. There still needs to be a lot of consolidation before people start investing in this asset class.
Okay.
Yeah.
All right. I get that sense of caution on property and real estate. Mr. Bhave, your view?
So it just stirred a memory for me. 11 years back, I had met Mr. Rakesh Jhunjhunwala, and at that time he had advised me to buy a house of my own, and that house has gone up 3 times. So for an end user, I think it is a fantastic time to buy. If you don't have your own home, and you look at Mumbai's population is same as the population of Australia, and people are still coming in. So today, if you don't have your dream house and you have the capacity of taking a loan, I think it is a very good time to buy. I agree with Ashish. If you're looking at investments, then residential is not the place. We actually have identified investment opportunities for HNIs in some special situations. In terms, for example, student housing, for example, warehousing, for example, pre-lease commercial assets, for example, even stuff like co-working spaces, co-sharing spaces, and affordable housing. And there are certain pockets where these can be bought, but these are for HNIs and for investments.
Okay, fair enough. So we have 30 seconds left on the show. One money-making tip or mantra that you would recommend for Modi 2.0 next 5 years. Ashish?
I think the carnage in the mid and small cap space is overdone. People should, I think, get a little bolder now and allocate more money to mid and small cap funds.
Okay.
The valuations are not looking, they look optically expensive, but they're actually not expensive because there are few loss-making companies which are skewing the valuations. Have faith, growth will come back, earnings will revive, and I think there's a lot of money to be made in the next 4-5 years in this
so
segment.
mid and small caps, that's your bet, Mr. Bhave.
I would say अच्छे दिन आ गए for the equity markets. Spend less, invest more, invest in equity, and for a normal investor, equity is equal to 105 minus the age.
Okay, all right, there you go. So those are the money-making mantras on money, money, money. Thank you very much, gentlemen, for being with us on the show today. That's it for this week. We will see you again next week.